Hello, thank you for tuning in. In this video, we'll be talking about the stock market, a very interesting concept. So, the stock market. Historically, markets have been a place where buyers and sellers meet to exchange products. So, stock market is nothing different than that. It's a place where people come together to buy and sell stock. So, we'll be talking about two main types of markets when it comes to the stock market: a primary market and a secondary market. I think it's much easier to think of it as different points in time. The primary market is where corporations sell their stock to the public to raise capital for whatever projects they have. So it's called the initial public offering. And number two, we have the secondary market. The secondary market is a place where think of it as a time where after the initial public offering, people buy and sell stock from each other. Right? So people buy and sell from people who already own the stock. It's called trading among themselves. And why do people do? So they trade among themselves, and the corporation who sold its stock to raise money doesn't come into this secondary market. So why do people trade stocks? Let's say you're old and you want to retire. So you sell the stock to retire, and let's say someone who is very young might buy the stock for his retirement. So the cycle goes on. That's just one of the example. So let's take an example of different stock markets. We have the New York Stock Exchange, Euronext. That's one name. And we have TMX and the London Stock Exchange. So these three things are corporations. They're exchanges, but they're corporations. Now I'll leave a link to our videos on the types of firms where we explain corporations. So corporations make money, profits. You might be thinking, how do exchanges make money? Now let me tell you how. So one of the ways they make money is through selling the real-time data, which means the stock prices that move very fastly. They sell that to the people. And after that, they have company listing fees. So exchanges have companies, like for the initial public offering, they put a fee on that. And we have software. So it's a software where firms buy and sell stocks. And finally, they put a fee on trading. It's a small fee on trading. It is very negligible, and that is why people still trade. It's a very small fee, but there are millions of people buying and selling, so the exchanges make a lot of money. And from the historic periods, people have been selling physically, meeting each other, and that's how the stock market has also been done, on floors. Right? You must have seen a lot of in the media where people do trading on the floors. But right now in 2019, the electronic age is going on, and there's a lot of electronic exchanges, but there are still a few floor exchanges. So please know that these days most of the exchanges are online. Okay, so let us go now deep into a few terminologies that are very essential in the stock market or in any markets. But essentially in the stock market, these are the basics terminology that you need to know. Okay, number one, we have the bid price. The bid. So bid price is basically the buyer's bid, and the prices the buyers are willing to pay is the bid price. Okay. Simple as that. Number two is the ask price. Sellers ask, and the sellers ask for a certain price. That is their ask price. And the difference between the bid and the ask price is the bid-ask spread. So buyers say, I want to buy at this price, and sellers say, I'm willing to sell at that price, and they meet at some point and the trade occurs. Number four is a limit order. So if you call your stockbroker and say, I want to buy a stock at $39.45 exactly, and that is why you put limit orders. On the other hand, market orders are for when you want to buy a stock at whatever price, right? You could say, buy the stock at whatever price, until the day gets over, or buy the stock at whatever price until the order gets filled. It is usually not the best method to go, but it does exist. Number 6, specialists. Specialists are a very special person. They are very important. They are like market makers. So when buyers don't have sellers, or when sellers don't have buyers, these specialists come in and they have to take the trade. And they have their own account where they use to trade. They have an inventory of stocks which they use to facilitate the buyers and sellers with their activities. And they are very important people who are in charge of maintaining liquidity in the market. We'll be talking about more of them in a later video, but I want to make sure you hear these terminologies at least at one of my videos. Okay, so let us talk about the different types of firms. The different types of markets. That's another video I'll put a link up to. And so the different types of markets. As we said, there are a lot of markets. So let us go on to different types of markets in the financial industry. Number 1 is commodity markets. The commodity markets is a marketplace where you can buy or sell orange. Orange is traded, and metals are traded, and oils are traded. Okay, usually they're traded in future contracts, which I will tell in a moment. And then we have something called the foreign exchange market, shortly called the forex market, where currencies are traded among people. Their price is determined by the supply and demand of the currencies. As in almost all the markets, the price is determined by supply and demand. And finally, we have the bond markets, where bonds are bought and sold. So all of these markets have something called the derivative market. The derivative market is, for example, I totally forgot about the stock market. The stock market is what we've been talking about. So as I was talking, the derivatives is a market that derives the value from all of these products. It derives the value from all of these products. And so let me just give you an example to make things clear. Derivatives are, an example is an options market. An option and a futures contract. Those two are contracts. Sorry about that. So an option contract and a futures contract. Those are two derivative products. And the place where they sell is called the derivatives market. A market in which you can buy and sell options, and market in which you can buy and sell futures contracts. We have to make a separate video on what options are and what futures are. But those are called derivatives. They derive their value from all of the other markets. Each market has their own option and future contracts. Now, if you really like this video and learned something new, please feel free to subscribe for more awesome content. Thank you.